TJX Companies just reported Q2 fiscal 2027 numbers, and while they beat consensus across the board, adjusted EPS hit $1.22, topping the $1.19 estimate, and revenue came in at $15.12 billion, which is a 5.4% jump year over year.
Yeah, and management also raised full-year EPS guidance to a range of $5.15 to $5.20. But, despite the top and bottom line beats and that guidance raise, the stock actually gapped down roughly 3% right at the open.
Right, which is exactly why we are digging into this for you today. Why does a stock drop on a beat and a raise? You really have to look under the hood at the segment breakdown to find the culprit.
Definitely. I mean, the aggregate numbers look great, right? Overall comparable sales rose a healthy 4%, and adjusted pre-tax margins expanded 50 basis points to 11.9%.
It kind of reminds me of a football team, like when your star quarterback struggles, but the special teams still win the game.
Exactly. You have these satellite segments doing heavy lifting to get those averages up. Home goods posted 7% comparable sales growth. TJX Canada was up 6%, and, international grew 7%.
Wow, those are solid numbers for the peripheral segments.
They are. But they are masking a critical failure at the center. Marmaxx, which is the core U.S. TJ Maxx and Marshall's business, posted a highly disappointing 1% comparable sales growth.
Just 1%.
Yeah.
I mean, that is tough for the main engine.
Yeah, it is. The CEO actually explicitly called this miss self-inflicted.
Wait, self-inflicted how? Like bad pricing?
No, not pricing or market share. They said it was just putting the wrong merchandise in the wrong stores at the wrong times. I mean, they do expect to have the assortment fixed for the holiday season, though.
We should probably question that premise, right? The CEO says it is a self-inflicted allocation error.
Yeah.
But are we sure they aren't using a logistical excuse to hide a broader drop in U.S. consumer demand?
That is always the fear.
Right, because it is much easier for management to blame a spreadsheet error on inventory than to admit, middle-class shoppers are tapped out.
It is a totally fair suspicion. But if you look at how off-price logistics actually function, the spreadsheet error defense kind of holds water. Well, TJX doesn't buy planned seasonal inventory months in advance like a traditional department store. They buy opportunistic closeouts. So that requires a hyper-precise, localized distribution network.
Oh, right, because they are constantly turning over random batches of inventory.
Exactly. If their allocation software misjudges regional weather patterns or demographic shifts, say sending heavy winter coats to Sunbelt stores in September, the inventory just sits there.
So sales velocity just dies.
Right. It is a pure execution failure on the distribution side, not necessarily a lack of foot traffic.
Well, execution failures carry a really steep price tag when you trade at a 29.3 PE ratio. I mean, at a premium multiple, perfection is basically priced in.
Yeah, any friction in that logistics engine gets punished, which totally explains that 3% drop at the open.
And looking at near-term risks, the Q3 profit guide of $1.30 to $1.32 actually missed Wall Street's $1.35 expectation. Add in like $21 million in recent insider selling, and you see why the market took some chips off the table.
You do have to balance those near-term execution risks with long-term institutional confidence, though.
You mean the BlackRock news?
Yeah, BlackRock just acquired a massive 9.85% stake in the company. And management certainly isn't retreating. I mean, they are aggressively expanding their physical footprint.
Right. They raised the long-term global store target from 5,285 locations to 7,500.
Exactly. They clearly believe the off-price model has a massive runway ahead of it.
But expanding a physical footprint by over 2,000 stores, while the core U.S. banner is struggling with basic localized inventory management, that is a serious gamble.
It is, which leaves you with an interesting thread to pull. BlackRock is taking a nearly 10% stake in a company where the flagship U.S. brand is stagnating.
While the international and Canadian segments are putting up 6% and 7% growth.
Right. It really makes you wonder, can an off-price retailer trading at a premium valuation maintain its high multiple if its flagship banner continues to stumble on basic inventory execution during the crucial holiday season?
That is the billion-dollar question. If Marmaxx can't fix its localized distribution for the U.S. holiday season, we might get that answer sooner than expected. Make sure you follow the show for our daily earnings coverage so you don't miss the breakdown of those Q3 numbers.